Hello and welcome to part one of our presentation on 1031 DST reporting for tax professionals. In part one, we provide a brief overview of 1031 DSTs, and then in part two, we delve into the basics of reporting a 1031 DST transaction and post 1031 depreciation. Before I get started, I am required to make a few disclosures and disclaimers. I encourage you to pause and read this thoroughly, but to hit a few of the most important points, this presentation is not a solicitation. There are material risks in investing in DSTs and real estate investment trusts, including loss of principal. No secondary market exists for DSTs. The fees and expenses associated with packaged real estate securities programs are typically higher than traditional real estate. These programs are sold as private placements and therefore are only available to accredited investors. And this presentation does not constitute tax or legal advice. A little bit about 1031 Capital Solutions. In a nutshell, we are an investment brokerage that specializes in helping rental property owners retire from being landlords. Our firm is called 1031 Capital Solutions because 95% of our business involves 1031 exchanges, and the rest involves situations where a 1031 exchange was not available, but we are still seeking to mitigate capital gains taxes. In the first quarter of this year, 2025, our team closed $100 million in DST equity, which represents more than 5% of all 1031 DST programs syndicated in the United States during that time. Our main office is in San Diego County, but we also have branch offices in Sacramento and Seattle, as well as team members in Los Angeles, Denver, and Portland. Personally, I've spent my entire career in one way or another helping clients cope with real estate taxation. This is essentially my family legacy, as my grandfather was Paul Gann, who co-authored California's famous Proposition 13. Please know that we have excellent educational resources for your clients on our website, including brochures, videos, blog articles, and our book, How to Retire from Being a Landlord, which can be purchased on Amazon but is available for free on our website. Okay, let's talk about the applicability of the topics in today's presentation, and this applies to parts 1 and 2. The most common client scenario relative to today's content is an individual owner of a rental property who, for any number of personal, financial, or regulatory reasons, wants to sell a property and reinvest 100% of their net sales proceeds into a portfolio of what we call passive replacement programs. Factors driving landlords to sell their rental properties, particularly owners of residential rentals, include increasing legal liability, screening regulations, security deposit restrictions, annual caps on rents, eviction procedures, the just cause tenant removal restrictions, negative demographic trends, increased state and local taxation, other macroeconomic factors, maintenance hassles, mold abatement, and looming capital expenditures. And for a lot of these folks, whatever they are selling is the last rental property they ever want to self-operate. And if you think having a property manager greatly reduces the hassles of rental property ownership, you have not spoken with enough mom and pop landlords. So based on these motives, our clients in this category will reinvest, again, their entire proceeds into passive replacement programs. The second most common scenario is a 1031 exchanger who already has a primary replacement property lined up, but the dollar amount is not adequate to replace the entire value of the relinquished property. In this example, the net sales price of the downleg property was $8 million, but the client's best option for an upleg property is only, say, $7.37 million. DSTs can be a great option for filling what we call the stub amount here, because there is no fixed or incremental investment requirement for investing in DSTs above the typical $100,000 minimum. For this and many other reasons, DSTs have become an increasingly popular way for larger investors to complete their 1031 exchanges without triggering what we call a taxable boot. As most of you tax professionals probably know, in a 1031 exchange, it's okay to fall short of replacing your full down leg value, but at some point, incurring too much taxable boot will defeat, mathematically, the purpose of doing a 1031 exchange in the first place. This is because under federal tax rules, all funds received in a 1031 exchange are treated first as recognized gain. Therefore, if you receive all your gain in a 1031 exchange, you end up with the same tax consequence, as doing no exchange at all. On that note, let's quickly remind ourselves of the consequences for not doing a 1031 exchange. In this example, a client bought a luxury rental condo for $5 million 10 years ago. The property has experienced 3% annual straight line growth for a total of 30% appreciation and netting a sale price today of $6.5 million. Most people intuitively understand that their appreciation represents a taxable gain, and in the absence of any significant offsets, a typical real estate sale will push them into the highest capital gains tax bracket. Not including state tax, that means 20% for long-term capital gains and 3.8% for net investment income tax, or NIIT, for a combined 23.8%. By the way, it's our understanding that the recent federal budget bill did not impact the rates and brackets for capital gains taxes. Unfortunately, appreciation is only half the story. In this scenario, like with all clients, the taxpayers have been deducting their depreciation every year as an offset to their taxable rental income. But when you sell a rental property, the Internal Revenue Code requires that you lower your cost basis by the amount of your cumulative depreciation, which here represents $1.82 million. Mathematically, this results in a total combined gain of $3.32 million. Even worse, the tax rate for depreciation recapture is 5% higher than regular capital gains tax. When the dust settles on this transaction, absent a 1031 exchange, the client will pay $1.1 million in combined state and federal tax on a property that only appreciated by $1.5 million. The solution, of course, is to conduct a tax-deferred exchange under Section 1031 of the Internal Revenue Code. This presentation assumes some basic understanding of 1031 exchanges, but as a reminder, a basic caveat of achieving complete tax deferral is the requirement that a taxpayer replace the entire value of their downleg property. For 1031 exchange purposes, the replacement value is not the full sale price, but rather the sale price minus commissions and other customary transaction expenses. Even if you paid off a loan in a 1031 sale, you still have to purchase a property of equal or greater value. In other words, to defer all taxes, you must replace all your equity and all your debt. As we'll see in a few minutes, a 1031 DST provides an opportunity to replace downleg debt without being a direct party to a loan, which is a considerable benefit to your clients who are often allergic to loan applications. In 2004, a real estate sponsor approached the IRS with a novel question. Under what circumstances, if any, would the IRS allow an investment in a property owned by a Delaware statutory trust to be qualified as a like-kind real estate in a 1031 exchange? The answer came in the form of Revenue Ruling 2004-86, which I suspect unknowingly spawned a multi-billion-dollar per year industry. In that ruling, a beneficial interest in a DST property qualifies as replacement property in a 1031 exchange, provided the DST only purchases real estate in cash, does not initiate additional capital calls, does not renegotiate or refinance the loan, does not renegotiate leases or enter into new leases, does not make major improvements to the real estate, distributes all cash other than necessary reserves to the beneficiaries, meaning the investors, does not sell or exchange the property and reinvest the proceeds. In other words, no turnover allowed within the portfolio. Based on these restrictions, even if you are not a real estate expert, your gut should tell you that the DST structure inherently limits the universe of potential deals to the most boring end of the real estate spectrum. And with rare exceptions, boring is the right word for DST real estate. Thankfully, boring is exactly what 1031 DST investors are looking for. The IRS provided rationale for this qualification on the basis that while the DST is a separate entity, it is an investment trust rather than a business trust, and also a grantor trust with the beneficiaries treated as direct owners for tax purposes. This is perhaps the most relevant distinction for 1031 purposes, as ownership shares in a business clearly do not qualify as like-kind real estate. The DST structure walks a fine line of being something akin to a disregarded entity for tax purposes, yet offering the same liability protection for beneficiaries as other business entities. Indeed, a DST is the only example under 1031 rules that allows a taxpayer to acquire property to which the taxpayer is not the publicly recorded title holder. Every DST private placement memorandum contains a 20 to 30 page tax opinion letter, and while Revenue Ruling 2004-86 is the foundation of each DST offering, most letters will cite numerous additional authorities to buttress their position. The heft of these somewhat boilerplate opinion letters is largely a function of the fact that private letter rulings are highly impractical for syndicated 1031 DST offerings. But we all take solace in recognizing that 21 years have passed since 2004, with tens of thousands of people having invested, many of whom have been subject to one or more IRS audits. DSTs today are no longer cutting edge, and if the IRS had wanted to backtrack or chip away at 1031 DSTs, they could have done so a long time ago. Having said that, there are some significant practical consequences of the caveats placed by the IRS on 1031 DSTs. Unlike tenant in commons, TICs, DST offerings are not limited to 35 investors, and 1031 deal sizes became much larger once the typical program moved from TICs to DSTs. Today, the typical size is $25 to $500 million of real estate inside a single DST offering. DSTs cannot raise capital like a fund. Once initial capital is raised, the offering is closed. In other words, no redemptions are allowed. All investors are effectively fractional owners and must wait for disposition via a liquidity event. No secondary market exists for DST interests. Lease terms cannot be altered. And so DSTs typically have a master lease structure across the entire property portfolio. Again, the loan cannot be refinanced. DSTs with debt have built-in expiration at loan termination, which is typically 10 years. The practical effect here is that any DST with a loan, which is most programs, has an implied expiration date equal to the loan term, again, of about 10 years. DSTs cannot engage in significant capital improvements. DSTs generally acquire stable properties. As a result, there is much more emphasis on income and capital preservation than appreciation. Trustees cannot seek additional capital. DSTs must set aside sometimes significant reserves, a few $1 million even, from initial equity and debt proceeds. If reserves are funded from equity rather than from loan proceeds, most practitioners consider such DST reserves to be boot. We'll be talking about that some more. And remember, investors do not have voting rights. Their experience is truly passive. I touched on this earlier, but it's important to understand how unique the debt structure is in DSTs compared to traditional real estate financing. Again, these programs have non-recourse financing in place between the trust and the lender before the first investor subscribes to the offering. For the client, there's no loan qualification, no application. The bank doesn't know who they are. There's no personal liability, no loan payment responsibilities, no notarized closing docs, no public record tying the client to the loan, and no longer an item on their credit report. And yet, the client is able to replace his or her down leg debt for 1031 exchange purposes. The typical DST loan terms are 30 to 55% LTV, 10-year term, fixed rate or effectively fixed rate with a cap, interest only for 5 to 10 years, 30-year amortization, sometimes assumable, sweep and reserve conditions often apply, and of course there are typically prepayment penalties on these loans. The minimum investment in a DST is typically $100,000, but may be between $250,000 and $500,000. The most popular real estate sectors for DSTs are multifamily, industrial, single tenant, triple net retail, and medical office. There are typically 1 to 3 properties in a DST portfolio, but sometimes as many as 30. No escrow is required to purchase an interest in a DST property. After signing the initial DocuSign, the closing process takes 3 to 5 business days. Ownership in a DST is evidenced by a certificate or closing statement. The process to re-register a DST interest is relatively easy upon such events as LLC dissolution or divorce or death or trust formation, etc. And at 1031 Capital Solutions, we have a dedicated full-time team to help clients with these types of maintenance issues. As I mentioned, title to the underlying real estate is held by the DST. Individual investor names are not publicly recorded. Most DST distributions are paid monthly, typically based on an annually adjusted target rate. The annual tax statement provides investor level data for filing a Schedule E, which is the same form folks use to report their rental property income, which I assume most of you on this seminar would know. And the average historic hold period for a DST is 6 to 7 years, which correlates to the average interest-only period of the loans. My point here is that sponsors generally seek to liquidate the property before the loan starts to amortize, which of course increases the debt payment and therefore reduces the distribution payments. The sponsors want happy investors who are likely to roll their investment into another DST program offered by that same sponsor. If your client invests in what we call a pre-REIT DST, that conversion from the DST to the REIT is going to happen over a much shorter period, typically around 3 years. We'll talk a little bit more about that. For some DST investors, there may be an opportunity to increase their depreciation deductions by acquiring more real estate in the exchange. And this is typically done by investing in a DST whose loan-to-value ratio is higher than their down leg property. Simple math dictates that when you employ higher leverage, you end up buying more real estate, which in turn increases your deductible cost basis. Furthermore, most DST properties have a much lower land value than a typical West Coast property, so the additional real estate acquired with debt will usually be 80 to 90% depreciable. Of course, you have to remember that taking on more debt also means that you will need to replace that debt in a subsequent 1031 exchange. Thankfully, the industry does a good job of providing a range of leverage ratios, and good sponsors will have replacement DSTs with adequate leverage ready for existing investors when their existing investment is ready to be liquidated. Earlier, I mentioned DST exit options. For the first 10 years of 1031 DSTs, they all had the same outcome. The sponsor would sell the property after 6 or 7 years, and the investors could either cash out, 1031 exchange back into traditional real estate, or 1031 exchange into another DST, which is what the vast majority of people do. Then, starting about 10 years ago, we began to see more DSTs structured as pre-REIT programs in which a large public real estate investment trust selects a property from its existing portfolio, repackages it as a DST, holds it as a DST for at least 2 years, then repurchases the property under a 721 exchange. Under Internal Revenue Code Section 721, the owner of a property, in this case a DST property, can contribute the property to a REIT partnership in exchange for partnership units without recognizing any gain. Today, half of all 1031 DST dollars are being invested in these pre-REIT offerings. Most of these programs are public, non-traded REITs that operate analogous to a mutual fund, meaning the REIT sells and redeems interests directly from investors rather than listing shares on a stock exchange. The redemption pool is typically limited to 20% of the REIT's net asset value in any given year, and investors must wait 12 months before requesting a redemption. Of course, liquidating interest in a REIT partnership is a taxable event, and such interest cannot be further exchanged on a tax-deferred basis. Under the pre-REIT strategy, investors lose the ability to conduct a future 1031 exchange, but ultimately they end up in a more diverse portfolio that is slightly more estate-friendly than a conventional DST. I should note, however, that REIT investors receive K1s, and the tax reporting is more labor-intensive than a typical DST, partially because of the high number of states that are represented within the REIT portfolio. In a typical DST structure, the sponsor buys the property, packages it up as a DST, and resells the property a few weeks later with a marked up price. Under state and federal securities rules, the sponsor is required to provide a detailed description of the full use of investor proceeds, including the original property purchase and all categories of the markup. The 4 major categories of a DST markup are reserves, syndication costs, sponsor fees, and transaction expenses. When your client invests in a DST, the entire balance of his or her bank account at the qualified intermediary is wired to the DST, and that entire amount divided by the equity offering amount of the DST determines the ownership interest in the property. But your client is indirectly paying for the markup expenses because those costs are already built into the price of the offering. Before I start talking about tax reporting in part 2, let me reiterate some of the most important considerations when investing in a DST. General real estate risks still apply. There are no guarantees. A client's income and principal are at risk. 5 to 10 years is the typical hold period for a conventional DST. DSTs are illiquid until the property is sold or until 12 months after a 721 UPREIT conversion. Investors must be accredited and meet general suitability requirements. We typically rely on the net worth test under SEC regulations, which require an investor to have a net worth of at least $1 million, excluding their home. 1031 investments require strict compliance with forms and deadlines, as I'm sure you all know. And as we just discussed, program fees and expenses are generally higher than conventional real estate. And so hopefully you already know how to find part 2 on our website. And maybe you can pause, or if there's anything you heard on part 1 that you want to clarify, you can go back, rewind, and listen again. Otherwise, part 2, we will pick up regarding the specifics of reporting the transactions and calculating depreciation. Hello and welcome to part 2 of our presentation on 1031 DST reporting for tax professionals. In part 1, we did kind of an overview of 1031 DSTs, the context that most of our clients are investing in DSTs, either for their entire 1031 proceeds or for what we call the stub amount. We went over structure, features and benefits, costs and risks. And now we are going to delve into the basics of reporting a 1031 DST transaction and post 1031 depreciation. To do that, we're going to do some screen sharing, and this will, in a recorded format, as you're listening, you may find yourself wanting to go back and take a look at some of the items on the screen, and which is very understandable, and encourage you to do so. So that's the advantage of watching this recorded rather than live. But what my goal here is to set up a scenario after the fact of a 1031 exchange involving the purchase of a DST, set up the basic facts of that scenario, and then walk you through how to plug in those numbers on a Form 8824. Okay, so again, we're going to provide a brief overview of how to complete IRS Form 8824 after investing in a DST in a 1031 exchange. Let's start with our scenario. Here, clients Jack and Jill Smith sold a single-family residence rental property on May 31st, which they purchased 10 years earlier and immediately placed into rental service. Jack and Jill originally paid $250,000 for the property and borrowed $200,000. The value of the depreciable improvements at the time of purchase was $115,000, which they have since depreciated using the standard 27.5-year schedule. Just before they sold the property, Jack and Jill installed a new roof and have not claimed that cost as an operating expense, meaning we will add the $15,000 cost to the basis of the property. As part of the sale, Jack and Jill paid $25,000 in commissions, a $1,000 fee to their qualified intermediary, and incurred $7,350 of customary transaction expenses. All these expenses are deducted from the sale price of the property for purposes of calculating the fair market value under capital gains rules. However, Jack and Jill also paid their prorated rents from escrow, which is not an allowed deduction in a 1031 exchange. As a result, that payment of $1,362 is treated as funds received by the Smiths in the exchange, also known as taxable boot or simply boot. At the time of sale, the Smiths' loan balance was $162,288. After subtracting all of these line items from the sale price, Jack and Jill had exactly $303,000 to transfer to their account with their qualified intermediary. To determine the Smiths' adjusted cost basis, we start with their purchase price, then deduct 10 years of depreciation deductions and add back their recent capital expenditure. The result is $223,182, leaving a remaining depreciable basis of $88,182 to carry over to the replacement property. This brings us to the Smith's replacement or upleg property, known as South Florida Apartment DST. This DST has one property, an apartment building in West Miami. The total equity in the program, meaning the amount of cash that is being raised by the sponsor from investors, was $24,836,065. The total debt was $25 million, and therefore the total offering price of the DST was a combined $49,836,065. The allocated ratio of the property's improvements is 85%, meaning that the land is only 15% of the property's total value. Of the nearly $50 million in total capital in the DST, $500,000 of loan proceeds went to reserves, and $500,000 of equity capital went to reserves. Based on the total equity raised, the Smiths' investment of $303,000 equals, 1.22% of the equity, meaning they acquired 1.22% of the DST. As it turns out, 1.22% of the debt equals $305,000. Ostensibly then, the Smiths acquired a total value of $608,000 in the exchange. However, according to some commentators, not all of the $608,000 of value may represent like-kind real estate for purposes of a 1031 exchange. Specifically, although the IRS has not publicly opined on this issue, many practitioners believe that the reserves set aside in a DST should be deducted from the investor's purchase price. Therefore, for purposes of this illustration, we will deduct the Smiths' pro rata share of the equity reserves from their equity and the loan reserves from their allocated debt. These are the deductions of $6,100 each, resulting in a total net replacement value of $595,800. Let's pause to review one of the basic rules of a 1031 exchange. To achieve a completely tax-deferred exchange, you must replace all of your equity with equity and all of your debt with either equity or debt. To determine if a disallowed item, like reserves, constitutes boot, we must determine whether the item in question has affected one of these requirements. On the equity side, the $6,100 reserve allocation reduced the Smiths' equity investment, and there was no corresponding payment of cash from them to offset the deduction. The equity reserves then would be treated as boot. The deduction for debt reserves, however, is not boot because the total allocated debt in the DST was far greater than the Smiths' loan balance. Based on these numbers, we can calculate the amount of additional or new cost basis the Smiths have in the DST, which is the difference between the loan they paid off and the net amount of DST debt allocated to them. Of this increased basis of $136,612, we know that 85% represents newly deductible improvements, or, as you can see in the green line, $116,120. Again, that represents the value of the newly deductible improvements above and beyond what the Smiths had been deducting on their downleg property. We now have all the information we need to complete Form 8824. So, A few important caveats to our scenario. There were no related parties involved in the Smiths exchange. The sale of their rental property did not include any non-real estate assets, and Jack and Jill do not intend to employ cost segregation and accelerated depreciation. On page 1, we reference the address of the Down Lake property on line 1. And on line 2, we write the Smith's percentage ownership, DST name, and property address. On line 5, it's important to note that if you complete the purchase of your DST before your 45-day identification deadline, you simply use the close date as the identification date. That comes from the instructions to the form. We can ignore this entire section part 2 because there was no related party in the exchange, and we can ignore questions 12 through 14 because the Smiths only sold real estate in this transaction. We pick up at line 15 where we provide our taxable boot. And as you may recall, we had 2 line items in our exchange that we deemed to be disqualified deductions for 1031 exchange purposes. Those items were the prorated rents from the sale and the prorated reserves from the purchase. Together, those items added up to $7,462. Put another way, this represents the difference between the net equity the Smiths received in their sale and the amount of equity that they ended up investing in their DST property. Line 15A is the description of these boot items. Line 16 is the total value of the Smiths like-kind property in the DST, meaning their share of the DST minus reserves. Line 17 is the sum of lines 15 and 16. Line 18 is the sum of the Smiths adjusted cost basis in their Down Lake property, $223,182, and the additional cost basis they added to the exchange in the form of additional DST debt, $136,612, for a total of $359,794. Line 19 equals line 17 minus line 18, representing the amount of gain realized in this transaction. This is not the amount subject to tax. Line 20 is the lesser of lines 15 or 19. On line 21, we repeat line 20 because this amount is less than the cumulative depreciation the Smiths have claimed on their down leg, which, as we saw, was $41,818 over 10 years. As a result, all of the $7,462 of boot will be treated as depreciation recapture and taxed under a special rate as ordinary income. As you can see highlighted here, you also need to report any number on line 21 also on form 4797, line 16. That's highlighted here in green. Line 22 equals line 20 minus line 21. Here the number is 0, but if it were more than 0, this would represent the total amount of boot to be taxed as long-term capital gains. Line 23 is the sum of lines 21 and 22 and equals the total amount of recognized gain, meaning the amount of gain that was not deferred and therefore subject to tax in this 1031 exchange. Line 24 is the difference between the realized gain on line 19 and the recognized gain on line 23. In other words, this is the amount of gain the Smiths deferred in this exchange. Line 25 equals line 18 plus line 15, which in most cases is a convoluted way of just repeating line 18, which is the new basis in the Up Lake property on day 1 of the investment. Of course, this cost basis will change each year to the extent that the Smiths claim annual depreciation deductions or to the extent that the DST makes non-deducted capital expenditures toward the property, which is usually minimal. I just want to repeat, so I'm not sure I explained this correctly as I'm hearing myself talk. Line 25 equals line 18 plus line 23 minus line 15. And so you're taking this number, adding this number, and subtracting back this number, which gets you back to the same number. In this scenario, these numbers get to be pretty redundant, which is I have found to be the case in many of these 8824 forms. But there are scenarios where you're not repeating the same numbers over and over again. And again, that goes back to really being impacted by depreciation and boot. Okay, because our scenario did not involve cost segregation, the entire DST is treated as Section 1250 property, meaning real estate that is subject to standard long-term depreciation schedules. Finally, Section 4 does not apply to the vast majority of people, which means we have completed our Form 8824 for this 1031 exchange. Filling out this form is a good time to determine what the annual depreciation deductions will be going forward. So let's go back to here. In our example, the Smiths have two sources of depreciation: the remaining depreciation of the downlink property and the depreciation of the incremental value of the newly acquired DST. The IRS allows two methods for claiming the annual depreciation deduction after a 1031 exchange. You can either add the sum of both separate depreciation schedules, known as the standard method, or you can combine the total remaining depreciable basis of both properties and divide the total by the applicable depreciation factor, known as the simplified method. Although that doesn't sound simple, that is the simplified method. In either case, the total amount of depreciation deductions will be the same, but the time period over which the deductions are claimed will be different. For the Smiths, it probably makes more sense to use the standard method, as they can deduct roughly $900 more per month during the first 17 years than if they used the simplified method. Their depreciations going forward would be their original schedule of $4,182 per year, combined with the new deduction of $4,223, which is the result of applying the DST's 85% improvement ratio to their additional basis of $136,612 to get, again, $116,120, and then dividing that number by 27.5, which the IRS has determined to be the useful life expectancy of residential rental property. As you probably know, the other common common number used for life expectancy of rental properties is 39 years for non-residential real estate. Okay, now getting back to our presentation. If you're still awake, I don't blame you if you're not, let's talk a little bit about how to read a DST closing statement at the conclusion of a 1031 exchange investment. I have three very real examples of how DST sponsors choose to report a purchase. And frankly, I could have shown you a dozen, but let's start with three. This first statement is very simple. the investor wired $1,133,333 from their qualified intermediary account into a DST that had a debt ratio of approximately 58%, which means their $1.13 million of equity ultimately bought them $2.7 million of total real estate because their prorated share of the DST property loan was $1.57 million. In this case, the DST equity offering was less than $22 million. So the investor's $1.13 million investment represented 5.23% of the entire DST offering. Here's another simple DST closing statement, but here we see that the broker rebated some commissions. When this happens, the rebate is treated the same as if the client added cash to the purchase from outside the 1031 exchange. Again, when there is a rebate of commissions, the rebate is treated the same as if the client added cash to the purchase from outside the 1031 exchange, regardless of where that discount came from. And that could be only from the representative who sold the DST. It could come from the broker dealer that sold the DST. In this case, it was both. But mathematically, the result is that amount of discount is essentially added to the client's account, resulting in a higher total investment value than the amount that they invested from out of their QI account. Okay. In our third example, we have a DST sponsor admittedly muddying the waters by adding details regarding the DST syndication costs to the closing statement. For the uninitiated out there, this type of closing statement understandably can cause confusion because these disclosures could be interpreted as delineating closing costs that somehow reduce the cost basis of the replacement property, or perhaps even constitute taxable boot. It's important to remember that in a DST offering, the sponsor of the program buys back a property, buys a property, repackages it as a DST, and essentially resells that property at a higher price, perhaps weeks or months later. Okay, again, in a DST offering, the sponsor of the program buys a property out there in the world somewhere, a new property to the DST. And essentially, over the course of creating the DST offering, doing the legal documentation, getting the filings done, and then adding fees and expenses, the end result is a property being sold in the form of a DST at a higher price, perhaps weeks or months later, than what the sponsor originally paid for the property. As I mentioned a few slides back, we call that difference in price the markup. And when I say a few slides back, that was in part one of the presentation. So if you did not watch these part one and part two consecutively, then that was not a few slides back. But in part one, we talked about the markup. It is the position of 1031 Capital Solutions and the position of virtually everyone in the 1031 DST community, I believe, that the only aspect of that markup that could be considered boot are the reserves. The concept of net equity, as described on this sample closing statement, is from the securities world, not the real estate taxation world. If this was your client's statement for 1031 exchange purposes, you would say that they purchased $836,475 of real estate. And in this example, there were no reserves. The fact that this sponsor used 2.73% of the client's investment proceeds on syndication costs, of course, is good information to have, but for 1031 purposes, it should not impact the value of the client's investment. Finally, let's take a moment to discuss end-of-year tax reporting for DSTs. It is an undisputed fact that DST investors report their share of income and expenses on Schedule E, which is the same form you use for reporting rental property income. However, DST sponsors use different names for these statements, including Substitute 1099, Investor Letter, Year-End Statement, and a few other names. But regardless of the title, the common thread across all these statements is providing a summary of all property level revenues, expenses, and depreciation, as well as each investor's pro rata share of those revenues and expenses, which are copied and pasted into the client's Schedule E. Keep in mind that the total distributions paid to the client over 12 months will never exactly match the total taxable net income of the DST. I will repeat this. Keep in mind that the total distributions paid to the client over 12 months will never exactly match the total taxable net income of the DST. The most common causes for this disparity are 1, capital improvements that cannot be deducted as operating expenses. 2, payments made to reserve accounts, typically required by the lender. 3, income earned in December but paid in January. And 4, in the later years of a DST, the portion of the debt service attributable to principal payments. Again, most DST loans have at least a 5-year interest-only period, so loan amortization is not a factor for the first several years, if ever. One final reminder on depreciation. A 1031 exchange will not materially impact a client's existing depreciation schedule unless they acquire more real estate in the transaction, typically by increasing their leverage. If a client sells a $1 million property with no debt and invests in a 50% leveraged DST in a 1031 exchange, they will end up buying $2 million of real estate for depreciation purposes. The bottom section of this statement provides the information for determining how much of that additional $1 million can be depreciated under a new schedule, which in this case is almost 97%.